Chris, thank you so much for joining the call. Yeah,
Thank you for the
nice to
invitation.
have you here. Yeah, for sure. I mean, we've been talking for a while now, and I appreciate you coming here and sharing a lot of your wisdom to our community, which is awesome. I'm just going to start by asking you a few questions, of course, and feel free to expand on each of them if you as you see fit. Okay, how's your day going? First, everything going okay?
It's fantastic. We are in the middle of earnings season, so the days are busy. The days are filled with earnings report, earnings calls. So, I mean, when you love the game, you love every day of the earnings season. So I know you love the game. You know the earnings season is pretty busy. So yeah, life is good actually.
Fantastic. Yeah, I agree. It's pretty busy, especially when companies in your portfolio start reporting. In some of them, like you get like 2 reports a day. So yeah, it keeps you busy for sure. Awesome. But just so our audience understands a bit more about your background, so for people who are new to you, how would you describe your investing philosophy in 1 or 2 sentences?
Okay, basically the way I like to invest is by having a concentrated portfolio, so roughly 10, 15 stocks, and quality companies. So companies that are superior to average and at a reasonable valuation. This is how I would describe the big picture, the way I invest.
Understand. And you take a long-term investment approach as well, right?
Yeah, no trading, no leverage, no crypto, no options, no short selling, a long, only boring approach that seems to work, the old-fashioned way.
Why? Why is that? What attracted you to that philosophy in the first place?
That's a good question. The TLDR is, it's too complex to have a long, short portfolio. It's too complex to have a options trading strategy. And I've seen too many friends lose too much money doing these kind of things. When it comes to leverage or when it comes to crypto, the way I want to invest is by valuing companies, doing the work, being a business analyst, not a stock analyst. Like you really want to invest in companies. So you want to understand what are the revenue drivers, how profitable they are. You don't have this for crypto. So crypto is out. After this, for leverage, you have the great Warren Buffett that says you don't need leverage. Time will be your leverage. So if you invest very early and you let time be your friend, compounding will help you. So you don't need leverage to grow your wealth in the long term. For options, too complex. I've seen too many atrocities in the option trading world. So yeah, basically the old-fashioned way seems to work, like the early days of many partnerships from value investors. And for short selling, I know what you think about this, but the upside, downside, optionality of short selling is horrifying. I mean, if you are wrong, you have infinite losses. And it's really painful for your portfolio, but also for your mind. Because after all, we are here to survive in the long term. If you have infinite losses, it will drain all your energy and drain your nights. So I want to be able to sleep well at night. And if I know that in my portfolio I have potentially infinite losses, I will not sleep well at night. So, I mean, it's plenty of removing things from your life. So you can only have a simple portfolio with simple companies you know really well.
Yeah, well said. So you were talking about that. You are referring to the asymmetry, right?
Yeah.
I completely agree. It's far better just to buy a great company that we think is reasonably priced and just wait on our terms, as Charlie Munger would say. Yeah, completely understand. Yeah, cool. You mentioned the word quality. What exactly does quality mean to you?
This is a good question. For some people, quality means extreme revenue growth.
Exactly.
For other people, it's like extremely wide moat. What is quality? If you want the hard data, so core metrics, basically you want to invest in businesses that are growing. So you want revenue growth. If the revenue is stable for the past 10 years, not quality. If the revenue is shrinking, the business is declining, not quality. You want a business that grows, boom, that removes a lot of thousands and thousands of stocks of businesses. Also, you want a business that is profitable. This is how I define quality. I only want to be invested in profitable companies with fat margins, improving margins. And how can you have an improving margin? It's because you have a competitive advantage. You are special, so you can raise your prices, you become more efficient, more profitable. And to do this, you need a moat, a competitive advantage. How can you be superior to competitors? How can you be superior to the overall stock market and the competition around here? So something with a moat, something that is growing, something that can sustain high return on capital employed for a long time. I mean, you have a few metrics. I mean, you talk about this on your YouTube channel: revenue growth, a ROIC, a return on invested capital above 10, 20%, all these kind of efficiency metrics that are useful. So yeah, quality company is sustainability of returns, being profitable, and growing. That's a good quality indicator. Yeah.
You mentioned, yeah, no, I agree. And as you know, I mean, I myself use many of those metrics as well. And what is your first filter? So, for example, when you look at a company for the first time, what exactly are you looking for? What will lead you to start doing more research into that particular company, or like excluding it altogether? What is the differentiating factor here?
Either you spend like 2 minutes on the stock, or you spend 2 months on the company. So basically you want to have a first impression of the fundamentals and see if you like them or not. For example, you can go on many websites and they will give you some charts. Well, you can spot some patterns. If the charts are up and to the right, if the revenue is growing, if the company is profitable, so you will see green, a positive number, or having losses, negative, and just in 10 seconds, you can spot these patterns. If you see bad patterns, for example, the profitability going down, you just dismiss it. You just remove it from your universe. And after this, the second filter, after you have done this small screening exercise, is to see if you understand the business model. So if that's something about a biotech company that focuses on a niche market in Spain because they have an edge in Spain, I don't have a clue what is happening here. If this is a company about rockets in Texas, I don't know what is happening over there. It is a small aluminum company in China. I have no clue what is happening over there. Plenty of examples. You want to be able to read the description of the business and say, okay, that's basic. I have basic understanding of what is happening in this industry. I know this. Maybe I was a customer, or I know somebody that knows somebody that understands this industry. So yeah, you want simplicity in the company. Something you also preach in your videos. You want simplicity. You want to understand the company. Something inside your circle of competence. And if the fundamentals are okay and your understanding of the company is okay, then you go deeper. And now the real work starts. This is where it gets funny.
Exactly. So you mentioned about something you understand, something that falls within your circle of competence. You mentioned about what we call quality metrics, right? And in terms of do you stay away from certain industries and sectors? Or for example, or you don't have any problem, for example, investing in a company that operates in a very cyclical and capital-intensive industry?
Well, yeah, I mean, the biotech industry, I'm too stupid to touch this industry. It's just too complex. You have the aviation industry, too hard. The airlines industry, too hard. Hotels, restaurants industry, too hard. You have most mining companies, too hard. You have all the pharma industry, Novo Nordisk, Eli Lilly, too hard. Plenty of companies that are out of the understanding. I mean, so many ways to say no. So many stocks, when you lack the numbers, when you say, I just don't understand what is happening here. The most difficult part of investing for the long term is sometimes you may be seduced by a very appealing opportunity. So something is extremely cheap, the numbers look good, but that's not within your area of expertise. So sometimes it's difficult, but you have to say, no. And there are some good exercises to know if something is within your circle of competence or not. For example, can you explain in simple words what the business does in 30 seconds? If you need to pull out to put ChatGPT or Gemini, if you have to search on Google what is happening, maybe it's too complex for you. Or if you need complex words to really understand what they're doing, maybe it's too hard for you. So simple words, so you will say no to all the businesses, 99% of the stocks actually.
That's exactly what I do, and I couldn't agree more. And so, for example, some people in my community, for example, decided to go to invest in Novo Nordisk because they understood the company far better than me. Right? I read one of the quarterly reports, and it just reinforced my thesis that that's outside of my circle of competence. I think it's too complex. I don't have any edge like in the obesity market, and I'm not even interested in learning more about that. Okay, so it doesn't matter how great the company may be, how great its fundamentals are, but then it's what you say, right? If you can't explain it, if we are not interested, then we have no business investing in it. And so, in what are the early signs, in your opinion, that a company's moat might be weakening? And for the audience, when we talk about moat, and you should know that because you've been following us for a while, but we are talking about competitive advantages, right? And so what are you looking for here, Chris?
Just to go back to the past point, you said you want to only do research on companies that you are interested in. And this is a very good point, by the way. I mean, maybe the fundamentals are very good, but if this is an industry that is not sexy for you, not interesting for you, you will not really understand what is happening. You will be too fast, or just you will not like the process. So you also want to be genuinely interested in the company, because if you are a shareholder, you will follow everything what is happening. Exactly. All the quarterly earnings you will follow. So you will need intensity to listen to the earnings call, to ask questions, to be curious about the industry. If you don't like the industry, move on.
Yeah, exactly. Otherwise, can we imagine checking in with the company on a quarterly basis? It will really feel like you are having a hard time, right? So you might as well devote that time to learning about something that you are interested in the first place. Yeah,
exactly.
But what about signs of moat deterioration? What are you looking for?
To understand how a moat can weaken, you must first understand how the moat is. What constitutes the moat? What are all the attributes that make the moat wide? So, for example, you may have a company that has, economies of scale and then stickiness from customers. Okay, why? So for both these attributes, you ask questions. What are the 5 reasons why you have economies of scale? 5 reasons why you have stickiness from customers. And then out of these 5 links, maybe one of them will die because of AI or something else. How strong is the moat? Are these 5 elements? The 5 elements are moving parts. If the 5 of them are weakening, then one of the attributes of the moat are weakening. And for all the companies, they will have several moats, several competitive advantages. Inside each competitive advantage, they have attributes. For example, I can give you an example. For stickiness of customers, now you have a great debate whether software companies will be disrupted by AI or not. For some companies, they have stickiness of customers. These customers have their data in their software companies, so you will not switch if you are a customer. I can give you an example with cybersecurity companies, software companies that are operating in the cybersecurity company. Their customers have been working with this cyber company for 20 years. They have all their data stored with this software company. What is the cost of moving and changing your cybersecurity provider? You may have a data leak. You may have you may lose your data that has been stored for 20 years. What is the cost of this? So some companies are willing to continue working with the same cybersecurity provider, even when sometimes the prices are going up, just to not have these big risks of data leakage. Because we are talking about a big conglomerates, big companies. You don't want any leak of information. So this is a huge cost, and it is what creates this stickiness from customers. What are these attributes? What if you have a new solution to just move data flawlessly? Boom, the stickiness is out. There is no moat whatsoever. A moat like this can die in a few weeks if there is a new solution. So yeah, these are a few signs how you can spot a weakening moat. And talking about we talked about the qualitative aspects, so what constitutes the moat, etc., with words, but you can also look at I would say, the margins. Sometimes margins give you early signs of a weakening moat. What if, for some reasons, a company that was growing margins again, sometimes they have declining margins? What are the reasons for this? Maybe the management will explain, yeah, we have to invest more in-house, so we have more costs. Okay, why? Because you're not competitive enough? Maybe because there is a competitor that is eating your lunch, so you need to hire a lot of people to just fortify your moat. Maybe these are early signs. So
Exactly.
maybe fundamentals, margins, return on invested capital, or maybe an acquisition. There are some companies that are known to grow a lot, like 20% per year. And now they are no longer growing a lot. Instead of growing 20% per year, they grow 6% per year. Oh boy, that's a big change. So to boost this revenue growth, they are doing acquisitions. Exactly. So they are buying other competitors to fake the number and say, look at us, we are growing 20% per year. So business as usual, guys. No, the DNA of the company is changing. You're no longer growing organically. You need to acquire somebody. Why? So you will have a lot of debt to make this acquisition. Why? So that's an additional cost. You will have some synergies that will never happen. Yeah, maybe you can spot some things if the philosophy of the company is changing, if the DNA of the strategy is changing, all this kind of thing. You have early signs. I don't know what are your early signs you're spotting for companies, but so far, some elements here and there are pretty helpful.
Understand. And so a lot of that transparency, for example, I think it comes down to management teams as well. In how important is the management team for you when analyzing a company? What are some red flags? That's
okay. Yeah. Do you want to talk about specific names?
Yeah, I mean, you can give an example, or you can just speak like in broader terms. Yeah, whatever feels comfortable.
Okay, I can give you positive examples that could be fine. You have Mark Zuckerberg from Meta Platforms, one of the best reversals we've seen in history for the past 10 years. Literally, the company was attacked in all fronts. The stock dropped 70% in 2022. I'm talking about Meta Platforms. And in 10, 11, 12 months, the company reverted back to its roots, focused on efficiency, and they started to grow again. So that's the captain of the ship that is moving the direction. And in 1 year, guys, trust me, wait 12 months, I will fix my issues. And he literally did what he said he would do. Literally, textbook, step 1, step 2, step 3. Okay, they completely screwed up and rebranded themselves into the metaverse company, Meta Platforms, and they invested billions of dollars in the metaverse. They were attacked by the ATT and the cookies from Apple. At the same time, TikTok and vertical videos, so they were late to the party. Okay, they made their cookies in-house with AI. They created the Reels, so their equivalent of TikTok, vertical videos. They monetized Reels, so new revenue stream, revenue growth reaccelerated, and they became profitable. They reduced losses for their metaverse project. Everything at the same time within 1 year. So I'd say that's the top 1 reversal company I've seen. So of course, management team is deadly important. And you have some companies that are taking longer to pivot. The best case of this is Mark Zuckerberg. You can pivot in 1 year. If you have many problems, okay, you can give them the benefit of the doubt and say, okay, I will give you 1 year to just pivot. There are some companies that are having problems and they wait 2 years, 3 years, 4 years, and nothing happens. So of course, a good benchmark is Mark Zuckerberg. How bad are you compared to Mark Zuckerberg? It's a good exercise, actually. How long does it take to pivot? How long does it take to fix all your issues? For Meta Platforms, it took 1 year. What about you? Did it take 4 years? You are 4 times worse than Mark Zuckerberg. This is a good benchmark, actually. And for all the companies you have in your portfolio, you want to see how flexible your management team is, how honest are they, And can you really rely on what they say? Can you really trust them if they have a guidance or if they have a project? I mean, do you really do what you're supposed to do? Very few companies are doing this.
Yeah, no, I agree. And in fact, if the management doesn't show any signs of transparency and integrity, that would make me feel more stressed, right? It's not good to hide things from shareholders, and it's not good to see. So when, for example, they brag about the company, right? But then you look at the financials and they go in the other direction. That's not good either.
Exactly. I mean, we just before this call, we mentioned some examples of companies that are announcing some buybacks, but at the same time, you have dilution of SBC.
Yes.
So some companies are very proud to announce buybacks. We will repurchase shares because we think we are undervalued, so we want to reward shareholders. And you look at the number of shares, it is going up because of all the concurrence they give to employees. I mean, come on, guys. How can you be so proud in the public market? And strangely enough, people believe them, but actually they are diluting the shareholders every year that goes by. This is what you teach on your YouTube channel, how to avoid these traps and double check everything what the management says. It's crazy.
Yeah. No, I completely agree. And we even gave some examples. And yeah, I'm not saying they are not good companies. They won't have a nice future. But again, I mean, it comes down. It's all about risk. It's all about risk reward, right? I mean, we are trying, especially because when we run a concentrated portfolio, we can't really afford to mess up big time.
Yeah.
So we have to do proper due diligence. We've talked a lot about quality management, meaning all of these things. But what about the valuation, the price you pay for a company? Do you think, you mentioned paying a reasonable price, right? Buying quality at a reasonable price. What does that mean? Do you buy with the margin of safety? How does that work for you?
This is where our views will differ.
Exactly. I know.
You have two camps of people. Some people that may say, okay, I want to buy pretty good businesses. And for these businesses, they are not viewed as darlings from the market. So I can get them cheaper. So yes, I can buy them at a margin of safety. And actually, I'm part of the other camp of saying, I want to buy the MasterCards of the world. Everybody knows they are great. So the valuation is reasonable, a little bit pricey, and you will never get the chance to buy them at a margin of safety. I've studied both camps. You just have to choose your side, but I have much more fun analyzing 10 out of 10 companies. I mean, beautiful companies that will never have a margin of safety, unfortunately. So I'd rather stay with the top companies. When they drop in price, they go from overpriced to fair value. Okay. Even if they don't have a margin of safety, I'm fine with that. For some of my best ideas, I bought them at a fair value, but they were exemplary companies. You have Fortinet, exemplary company. You have MasterCard, exemplary company. You have TPL, exceptional company. I mean, maybe the best business model on earth. And when it comes to valuation, to give you a ratio, you can look at the P ratio, price to free cash flow. The sweet spot is between 20 and 30 for P ratio and price to free cash flow. I don't mind looking at one or the other metric. Most of the companies I invest in, similar to you, by the way, are very profitable. So most of the net income is converted into free cash flow. So whether you look at the P ratio or price to free cash flow, same thing. So yeah, between 20 and 30. With that said, if there is a very good business trading at a P ratio of 7, I'm a buyer. I made a lot of money on Williams-Sonoma that was exactly in this situation. Pretty good company, retailer, cyclical, P ratio of 7. They repurchased, let's say, 10% of their shares, and they improved efficiency. So sometimes you can make a lot of money for these special situations, but it don't come often. Most of the times, the majority of the holdings are quality companies, P ratio 25, sometimes 30. And you just hold, and over the very long term, most of these exemplary companies will do better than what you think. This is also something that is forgotten in the stock market. Sometimes you have estimates and you think, okay, this business can grow 12% per year. But for exemplary companies, like the best quality companies, they announce they make 12%, but actually they are doing 15% per year. So they are doing better than your own estimates. So the high PE ratio is warranted for some companies. You just have to not overpay. If you pay a PE ratio of 50, good luck with that. Good luck with that.
Is that what you think is overpaying? So, for example, if you see a great company, for example, Fortnite, right, in the cybersecurity space is a great company. What is the price that you are not willing to pay? Is it like something, for example, like in broader terms, like is it above 30? That is a bit of a stretch for you?
Yeah, up to 35, okay, if the quality of the company is exemplary. Above 35, I'm not touching it.
Okay.
I almost never bought things at a price of a cash flow of 40. So yeah, up to 35, I would say. The sweet spot is 25, 30. Above 35, that's too much. For Fortinet, actually, the price was really high last year. And in summer 2025, it dropped from a price of free cash flow of 45 to 30. Like it dropped meaningfully. I bought at 30. Yeah.
Yeah, that's meaningful. Probably because they were caught up in all this like volatility that we are seeing across software space, right? I mean, it's interesting because, and this is where we can find other opportunities. But there is a company, and just because I've been doing some research into these guys, and they have been a phenomenal compounder. Many quality investors have been were touting this company, and rightly so. And you probably know the company I'm about to talk. I'm about to discuss is actually Constellation Software, and still the stock is like right now is over almost 60% down. Do you think this? That AI fears are overblown, or do you think even vertical market software companies, right, and Constellation operates in that segment, will still be affected?
Actually, if you've been waiting on the sidelines to buy Constellation Software, maybe now is a good time.
I know it is. Oh yeah, from a valuation standpoint, it ticks all my boxes.
Yeah.
So I'm doing more research right now, but my understanding is that vertical software. So those that operate in the vertical software segment probably won't face meaningful disruption. That's what my conclusion has been so far, but I still need to do more due diligence. But I'm liking what I'm seeing so far.
Yeah, Constellation Software is known for acquiring businesses. Organically, they don't grow. They almost don't grow. So all the growth is because of the acquisitions, and that's part of their DNA for 20 years. Now, all the software companies are losing in value, dropping in price. So it's like Christmas for Constellation Software.
Exactly what they mentioned and what I saw some analysts discussing. Because they are a serial acquirer, what happens is they have plenty of buying opportunities ahead. But one thing that I didn't really like, but I don't blame them, I think they would be lying if they said otherwise, is that AI is such a big deal that they actually held a conference call on AI a few months ago, I think 2 months ago, and they say they don't know. So they don't see any disruption so far, right? So, they own more than 1,000 companies, but they don't know what the future will look like. So they couldn't provide a direct answer to analysts' questions. But how could they, right? Nobody knows what AI is gonna create. But I find it hard to disrupt because they serve so many niche companies, right? Like mission critical software. It's hard to believe they are going to be severely disrupted. But I don't know. But at the point, everything else with the company is awesome, as you know, right? Fantastic. Yeah. They are down massively, man. They have a tremendous track record, a lot of skin in the game as well. Everything is awesome. Great reinvestment opportunities. So let's see what my conclusion will be. But it's going to be, so far I'm liking what I'm seeing. So, but for example, I can tell that I would feel more comfortable investing in a company like Constellation than Salesforce.
Yeah.
For example, okay? And I understand how sticky Salesforce products are, having been in software space, but I'm more comfortable with vertical software in the vertical software market.
It's more niche. More
More
niche.
niche. Yes.
The stock is down 50%. I just checked for Constellation Software. So the valuation was high, and now we are back to reasonable. Do you value Constellation Software based on the price to free cash flow, or you have this metric, the free cash flow available to shareholders?
I personally use price to free cash flow, and I think it's the cheapest the company has ever traded at.
Yeah.
I think it's 16, man. I think it's a price to free cash flow of 16 or 17. I mean, from a valuation standpoint, and not just valuation standpoint, it ticks all the boxes. The only reason I haven't bought yet is because I'm doing more research. But so far, I like what I see. So we will see. Don't know. I don't know.
Yeah, I mean, time is your friend right now because the stock continues to go down and down and down. So the longer you wait, it seems like
I know.
It will actually help you. This is very niche. The new management team, he owns like 1% of the shares. So in terms of insider ownership, you're fine.
Yeah.
And I mean, if you don't buy now, when do you buy? Frankly, when do you want to buy?
Probably by the end. Not probably by the end of. I'm nearing the end of my research. By the end of this week, I'll have an answer.
Okay, sure. Good.
And so I mean, I'll have to come to a decision, but I have capital on the side that I want to deploy, and they are definitely a serious candidate.
Yeah.
So
I agree.
What about in terms of emotions right here? Right. So what situations do you think can test an investor's emotions? Yeah. How important do you think emotions are at the time of making an investment decision?
Oh, extremely important. If you are somebody with anxiety, don't invest. If you are somebody that is stressed by all the things of life, don't invest. If you are somebody that is watching the stock price move on a weekly basis, on a daily basis, on an hourly basis, don't invest. If you are subject to confirmation bias, so you love to only hear your own opinion and you only watch videos that agree with you, don't invest. If you are being influenced by Twitter by some random guy in a random country in the world, and you say, oh, he's right, and you change your mind every day, don't invest. You need conviction in this game. So Warren Buffett said the most important thing in investing is temperament. You need to be cold-blooded. Stock prices will smack you in the face and you will lose 20% in one day. How do you react? The only test here is time, because you have a hit rate that will never be 100% in investing. You will always lose minimum 1/3 of your trades. 1/3 of your big ideas with a lot of conviction and pride, you will lose. You will be wrong. So now that you know this, you will be wrong minimum 1/3 of the time. How do you react when you are wrong? Do you double down because you have this confirmation bias and you say, I'm too strong, I cannot be wrong? Or how do you react? And how do you react when you are right? Are you celebrating too early? Or are you telling all your friends about it? Or are you staying humble? Because over 1 year, you can be a genius. 2 years, you can be a genius. 3 years, you can be a genius. But over the next 10 years, temperament will be maybe the most important thing. You can be lucky 1, 2, 3, 4 years, up to 5 years. I would say it's not luck. 10 years, it's impossible to be luck. So emotions will determine how big you swing when in doubt. And your example of Constellation Software is exactly this. You are doing the work, you know the stock dropping, you're not panicking to buy, you are doing the work to build conviction. Once you have gathered the bad opinions, the good opinions, the positives, the negatives, you make a big bundle in your head and you make a decision and you swing hard. This is how I view investing. Emotions, temperament, you just know yourself and take your time.
You know, it's interesting because both you and I are coaches, investment coaches. And I think, and by the way, for the audience who probably don't know about Christopher up until now, Christopher has been compounding money at over 20% for the last 10 years. So I think we should definitely listen to what he says. But based on my experience with people that I've been coaching, I would say temperament is the thing that they need more. They need me to guide them, right? So they need guidance in terms of temperament, because even though they may know the framework already, sometimes it's difficult to pull the trigger on an idea when the market is so depressed on that name. Do you feel the same way?
Yeah, there is a quick fix to this actually, because I had the same thing. Some people were worried back in April 2025, when all the market went down. The whole market went down 20%. The Nasdaq got crushed because of tariffs and Liberation Days. Liberation Day, fair enough. Before investing, the quick fix is to ask questions. Before you buy a stock, you say, what can go wrong? What are the 5 risks that can kill my idea? And how big these impacts will be on my stock. If for all my stocks, I know all the risks, I know everything that can go wrong, when the stock is going down, I can know in advance how I will react. If the stock goes down 10% because of a risk I had in mind, you say, okay, I expected this. So you can have a better state of mind to make a decision. Is this a temporary problem? And the problem will no longer be here in 1 year. So the management will fix the problem. I can have the opportunity to double down and buy more because I have done the work before. So I know it's a temporary problem. I know it will rebound, so I can buy more. Everybody will freak out, but I know in advance what can happen. Or is this a bad long-term problem that will hurt the business? So you can exit the position because you are prepared in advance. So emotions are something that can make or break you in times of panic, like if there is a market correction. A good way to survive these market crashes is to prepare in advance. What are the 5 things that can kill my idea? 5 risks that can impact my business? It's all about preparation before. And I agree with you. Emotions are killing the ideas of people. They sell at the wrong time. They panic buy, panic sell. This is very true.
And based on what you just said, I assume that you will size your portfolio based on how convinced you are in certain names, right? So, for example, your highest conviction holdings then are probably the ones where you have a higher percentage of your portfolio allocated to. Is this correct?
Yep. You want your biggest holdings to have your biggest conviction. How confident are you in your analysis?
Exactly.
You have a weak idea, a weak opinion, or strong opinion, you are really sure of yourself. And 2, it's about risk reward. So this is what famous investor Joel Greenblatt says. You want your first position to be actually your safest position in terms of what is the maximum upside you can have and maximum downside you can have. If you are invested in a micro cap as your first biggest position, good luck to you. I'm not on the same team, but good luck to you. You may lose 80% of your wealth because that's a micro cap. Anything can happen for a micro cap. And the maximum upside, it depends. Maybe a micro cap company can get acquired by a big company. So the upside is 20%. That's maybe something that will happen. But the downside for a micro cap is, it can get bankrupt because of some fraud. All micro caps are potentially frauds. You have so many examples in mind. So you want to assess the portfolio structure in terms of 1, conviction, how sure are you of yourself and your understanding of the business, etc. And 2, risk reward. How much money can you make if you're right, and how much money can you lose if you're wrong?
Completely agree. So when you are doing the analysis, right? I know that you think as a business owner. So how far into the future are you really thinking at the time of running your analysis? Is it 5 years, 10 years?
Wow. Let me get my crystal ball for you. So it's so hard. In terms of numbers, 3 to 5 years, but you will be wrong. So even if you make a DCF, you will be wrong. You will always be wrong. So it's better to be conservative, be roughly accurate with the numbers, rather than being precise, because you will always be wrong on valuation in the future. In terms of business quality, or you can look at the next 5 to 10 years. Also, you can spot where you think the business will be in the next 10 years, and you can reverse engineer and saying what will be the attributes that will increase the chance of the good future happening, and what will be the worst case scenario, what can prevent the business from achieving a positive long-term destination. So again, what are all the things that will be good, all the things that will be bad, and what are the odds of this happening? So for the numbers, you will be wrong 3 to 5 years in the future, that's fine. For the qualitative aspects of the business, yeah, you can look at the 10. I don't know what you think about the visibility, but 10 years is very difficult to forecast.
Cool. Yeah. I mean, yeah, I understand. It's better to be, as you said. I mean, I don't know who said that. It's better to be approximately right than completely wrong, something like that. Yeah,
exactly.
Along those lines. Yeah, awesome. So for someone who is just getting started, right? Someone who's just trying to get their head around the stock market and investing, what would be one advice you would give them? What would be, for example, a good advice you would give to Christophe like a 10-year younger Christophe when you started?
Contact Eduardo. You have an email, a comment section below this video. So contact people that can help you. This is you want shortcuts in life. So sometimes the best way to have a shortcut is someone literally telling you what to do. After this, you have books, and investing is not for everybody, but you have to try. You have to try. And when I was younger, I did some, paper portfolio trading. So paper gains. It's better to not do this, because you will see how painful it is to lose money. And you will see right away if you like the game or not. If you like to be a detective, to find things, to look for ideas, to exchange with people, you will see right away if you like the game or not. For some people, they try the game, some friends, they try the game for 1 month, they lose money, they quit. That's it. They know it's not for you. But before, they were playing with paper, trading paper for months and months and months and months. And say, I like the game. When you are faced with reality and a real portfolio, you know exactly if this is good for you. So jump in the arena and try.
Yeah. And what's one last question to wrap up? What's one book that you would recommend? Because you are a devout reader as well, like I am. So what's one book that you would recommend?
For beginners?
Right? For beginners, yes.
I have one actually. You have the great book, I think it was released in 2021, Richer, Wiser, Happier by William Green. It's about investing, but also philosophy. It's about the story of 7, 8, 9 investors, legendary investors, and their view on life, their philosophy, their mindset, their mentality, temperament, and investing lessons. So it's really complete. And for a beginner, you read it, and you know right away if you like this, if you like to be like these people, or it's not for you. So you will know right away. It's a great book. It's a rather short book. And what about you? What would be the number one book you would recommend?
Whenever I'm asked that question, I always go back to the same books. So because those are the ones that really made a difference to me. They are Phil Townsend's books. So Phil Town Rule Number 1 in Phil Town Payback Time. Those books, I think, most of these ideas, they stem from The Intelligent Investor by Benjamin Graham in Security Analysis. But then they just unpacked a lot of those concepts in a very accessible manner. So that's why I always refer these two books. But there are so many, so it's hard, But that book, as a matter of fact, I've never read. It's been on my reading list for a while, but so I have to do that as well, because I know I've watched many. In fact, I think he even has a podcast, and I watched some episodes as well. Green, right? William Green.
Yes,
Something.
exactly.
William Green. Yeah, that's the author. Cool. Chris, thank you so much. Yeah, for taking the time to share a lot of knowledge with our audience. And let's see what the market has in store for us. Throughout 2026, I think we will see more volatility. But for us long-term investors, will certainly present us with great opportunities. So we will see. Thank you so much for being present here.
Thank you for the invitation. It was always a pleasure to chat with you.